Welcome to Retire Smart Maryland. My name is Cynthia DeFazio, joined today by Prashant, Sabapathi, and Ozzie Culhagil of Elite Income Advisors. And to our viewers at home, with so much focus and attention going on right now with the federal job cuts and forced early retirement, we're going to talk about some 5 things that you can be doing right now to make sure that you are protected if this actually is you. Prashant, how are you today?
I'm doing great. Wow, there's so much going on these days.
Yes.
That our office has just been busier than ever, which is in a way a really good thing. But I think a lot of people are concerned with the status of the economy and
Yes.
jobs and everything. And so I'm really excited to go through 5 things that people
Yes.
can do proactively to make sure that you're prepared for an early retirement. Heaven forbid you're forced into it.
Yes, it's such a topic of conversation right now. But Ozzie, I want to ask you, how are you today?
I'm doing great. Yourself?
Good, so good. Thank you so much. Such a pleasure to be with both of you. Well, obviously, as you just mentioned, Prashant, turning on the TV, that is the main thing that people are concerned about right now, these proposed federal job cuts, being forced into an early retirement. How can you be proactive?
So we put together 5 things, and what I'd like to say is that this is not unique to just federal employees. I think with the potential of, recession maybe, or just unemployment going up, I think businesses and the government are looking for ways to cut expenditures. And so when that happens, layoffs tend to be natural. And if that were to happen to you, how prepared are you to retire early if you're find yourself in that position? So look, there's 5 things that we want to talk about to get prepared. Number 1, I think, is maximizing your foundational income. And so one thing Oz and I talk about all the time is the importance of having a reliable stream of income when you get to retirement. What we always say is, look, while you're working, your financial life really just is what we call money in and money out. Your paychecks come in, your expenses go out, and you try your best to save as much money as you possibly can over time. Now, when you retire, that doesn't change. It's still about money coming in and money going out. The thing that changes, though, is where the money in comes from.
That's true.
If it doesn't come from your paycheck, it's got to come from somewhere else, whether it's Social Security or a pension, if you're fortunate enough to have earned a pension. Those are the sources of income. But what happens when pension and Social Security don't make up enough income after taxes to live your life in the most fulfilling way possible? You now have to tap in to your retirement savings. And so this is where we can use things like dividend assets to create more income. But the one that's become really popular is the use of these annuities. Okay, so Oz, you want to talk a little bit about the use of these annuities and why they could be a good source of reliable income for folks when they get to retirement?
Yeah, so when the people come to our office, what we do is we put together an income for life report. And like Prashant says, we find out how much money is coming from the Social Security, how much money is coming from if they do have any pension. And most of the time, there's some kind of a deficit. So, we do the reverse lookup and find out, like, how much do we actually need to put into a source that is going to create us a guaranteed income stream, which most of the time we found that to be the fixed index annuities are the best sources to get this income. So all we need is, how much income do you need? If you need $10,000 of income coming in every month net, how much from Social Security, how much your other resources, then we find out, what's the deficit, and we go from there.
Okay, so I love that you mentioned fixed index annuities, because there is a difference when we're talking about annuities. So you're recommending staying away from variable annuities overall, because those can be a little scary. Correct me if I'm wrong.
Yeah, so look, I think we want to stay away from making blanket statements, because everyone's plan is just a little bit different. But I think one of the biggest things we go back to is identifying if you have an income gap. So in Ozzie's example, you need $10,000 a month. You total up Social Security and pension. Let's just say you only have $6,000 a month coming in from those 2 sources. So now inherently you have a gap in your income that is $4,000 a month. Let's say that you saved $1.5 million for retirement. What if there was a way, hypothetically, that you could take $500,000, 30% of your portfolio, and put it into something like a fixed index annuity, which is totally safe? You cannot lose any principal on that type of an investment due to the market going down. And that $500,000 that you place into this vehicle will generate enough income to potentially close that gap in your income.
Perfect.
What kind of safety, what kind of security would that give your retirement plan if you knew that you had all the income that you needed and wanted coming in every single month to live life in the most fulfilling way? So several different types of annuities out there. I want to stay away from making a blanket statement that one is absolutely always better than the other. But if you have a gap in your income, folks, you need to figure out a way to solve it, and you need to figure that out before you find yourself in a position that you're forced into retirement sooner than you originally had planned for.
Absolutely. And also, isn't it important to reassess your investment risk? If you're forced into retirement sooner than later, and if you're taking too much risk, the one thing that I'm thinking is that perhaps you don't have the time to make it up in the market if you are taking too much risk and you're facing a loss. So how important is that?
Look, I think history has shown us that in order to be successful investing money, if I had to rank all the factors that drive success, I think that time is the single biggest driver of investment success, meaning the longer you can keep your money in the market without touching it, the higher the probability is that you're going to earn a return on your investment. So we need time to be successful, but when we get to retirement, what is the one thing that we don't have quite as much of?
Time.
It's time. So on one hand, we need time to be successful. However, when we get closer to retirement, time is the one thing that we don't have quite as much of. And so that's where we have to look at understanding what your loss potential is,
Absolutely.
right? How often do we see people that come into the office and they tell us, we ask this question to every single person that we sit down with without fail. We ask this question, on the retirement savings that you have, how much can you lose before you begin to feel uncomfortable?
Great question.
And some people will tell us, Cynthia, they'll tell us 10% is my number. So if I lost more than 10%, that's what makes me upset. And then we run this risk analysis, and what do we find?
They have 40%, 50% they can lose. And also, most of the time what happens is, like he says, the people say, I can lose 15%, right? Then we calculate and we tell them what's the 15% in their portfolio in a dollar, and they say, oh, no, I cannot lose that much money. Okay, so you actually don't want 15%.
15% sounds a lot different than $150,000 against $1 million. I mean, to me, $150,000 is a lot of money.
Absolutely,
right?
it is.
To lose, especially when you're really close to retirement.
That's scary.
So, folks, if you're sitting at home and you know what's going on in the world right now. If the market is uncertain and that is keeping you up at night, if you're unsure whether or not you can weather another bear market right as you head for retirement, you need to pick up the phone and give us a call. We're going to put the phone number up here. It is 833-308-5200. That's 833-308-5200. If you're unsure whether or not you can withstand another bear market as you head for retirement, pick up the phone, give us a call. When you come into the office, you'll be able to sit down with our team of retirement specialists. We're going to take you through our Retire Smart road mapping process. It's going to involve us putting together a true risk assessment to show you how much you stand to gain potentially in a good market, but more importantly, how much you stand to lose potentially in a bad market. And if that were to happen, how that loss could affect your retirement readiness. That is a totally free appointment to come in. It's totally complimentary. There's no obligation to do business with us or become a client, but it would give you what you need to make educated decisions as you head for that next phase of life. The phone number again, 833-308-5200. You can also pull out your cell phone and scan this QR code at the bottom of your screen. You'll be able to schedule a complimentary visit with us that way as well.
Prashant, thank you so much. Ozzie, thank you so much. To our viewers at home, the number to call is on your screen. That number is 833-308-5200. Remember, if you're forced into retirement early, you want to take some steps that are going to be able to protect yourself, protect your assets. You deserve to have the retirement of your dreams. Call in today, 833-308-5200. We're going to take a very short commercial break. Don't go anywhere. I have so much more on Retire Smart Maryland with Prashant Sabapathi and Ozzie Culhagil when we return. 。
Growing up, my father was, he was a mechanical engineer and he was always into the numbers. So I was always big on the numbers. Whenever it comes to finance, whenever it comes to clients, the accounts and this and that, I like to do all of these things on my head so I can give them as much as possible correct answer. I finished with the PhD in the economics. I started working in one of the biggest companies in the United States as an insurance advisor, and a couple of years later that I found out that I can be better served if I'm working for myself, so to speak. Being an independent is slightly different than working for a company. When it comes down to the people's life, like there is so many solutions out there. When you're independent, you can give all these solutions to the clients. And I'm there until, my last client leaves. It can be 6 o'clock, 7 o'clock, 8 o'clock. I don't look at the clock. So the work ethic is really important. And you just always have to try to do the best for your clients. As long as you do that, it will be fine. It's, again, it's challenging, but it's out there.
Welcome back to Retire Smart Maryland. My name is Cynthia DeFazio, joined today by Prashant Sabapathi and Ozzie Culhagil, and we're talking all about if you're forced into an early retirement, what are some things that you can do to protect yourself, to protect your assets, to make sure that you and your family will be okay? Ozzie, I want to ask you a question. One of the things that we talk about often on the show, but specifically if someone is literally forced into an early retirement, how important would it be to slash debt and reduce your fixed expenses?
It's very important because, at the end, our retirement is all about the income and the expenses, like how Prashant says, like how much money is going to come in and how much money is going to go out. And most of the time, the people really don't pay attention to small stuff like the subscription that they signed up like several years ago.
True.
They don't need it anymore.
That's true.
And all these things goes to the credit cards, and some people pay attention, some people don't pay attention, and all of a sudden that you might be paying several $100s for subscription,
right,
which you can save. And the other thing is when it comes to the retirement, we don't really want to be on the credit card debt or, high interest loans or big car payments.
Yeah.
It's like this is the time that reduce all unnecessary payments and focus on the things that what I call is the things that we want to do.
Yes.
The vacation and, splurging our, kids or
yes,
grandkids. We want to focus on that side. That's why we need to find out what's our unnecessary debt and expenses and get rid of those.
Yes.
Debt
yes.
is stress at the end of the day, I think.
Totally
right?
is. Absolutely.
More debt, more stress. Retirement should be about less stress, and as a result, lower payments. Less debt typically leads to less stress. And that's what you deserve, quite frankly, after 30 or 40 years of hard work.
Yes.
Is a stress-free retirement. So love that idea. Gotta put a spending plan together. By the way, if you've never done that and you need help putting that spending plan together, give our office a call. We have different resources that we can connect you with to help you get on that path, especially if you've never done it before.
Yeah.
And I think a lot of people, Cynthia, are afraid to ask for help.
They are.
Okay, they feel embarrassed that they haven't done the planning. Well, I got to tell you, most of the people that come to visit with us haven't done enough planning, and so you're not alone. And so if you're feeling a little shy about it, if you're feeling embarrassed, you are not alone. Just give us a call, schedule that complimentary appointment, and let's get on track. Better to get something in place now than to bury our head in the sand and ignore it.
I couldn't agree more, Prashant. Thank you for saying that. Also, let's talk a little bit how important it is to secure your health care and your long-term care plans. We need to talk about that because obviously health care, the costs are rising, rising, rising. They're through the ceiling. So how do you help plan for those things?
I think the first thing that we have to talk about is how Medicare Part A and Medicare Part B on its own typically does not give you all of the coverage that you need. We're fortunate enough that we get to visit not just with our own clients, but we get to visit with advisors from all over the country. And what we're finding is that the issue of healthcare and long-term care is not unique to the folks in the Baltimore and Washington, D.C. area. We talk to advisors in Ohio, in Tennessee, in California, And healthcare costs are going up, and this is a concern for a lot of folks. So you have to make sure that you have a Medicare plan and a supplemental plan that properly covers you, right?
Yes.
If you have prescription drugs that you're on, you want to make sure that your Medicare plan is going to cover the medications that you need to have covered when you get to retirement. So to me, this is what comprehensive planning is all about. It's not just about investments, or it's not just about income and tax. We have to loop healthcare and long-term care into this equation. Talk a little bit, Oz, about long-term care. And for those that don't know, Oz, you know, you're a bit of a specialist on the insurance side of things. Now, insurance isn't the right fit for every single person out there, but talk about long-term care costs and maybe how people can protect themselves a little bit as they get to retirement, specifically with long-term care in mind.
Yes.
And these days, when you look at it, back in the days, this long-term care wasn't as expensive as it is today. And now where we are around the Baltimore, you know, Maryland area, we see price about like $10,000 to $15,000 a month is the long-term care expenses. Either you get help, you know, in your house, or you go to a facility that they're going to be taking care of. And most of the people do not plan for this at the beginning. And when the time comes in, it's already too late to make any plans. And these days, there is a lot of different options available. Back in the days, you know, our parents has like, you know, long-term care policies. It was a straight policy. You were buying it and you were paying for it. If you use it, it's good. If you don't use it, it's gone. Now, these days, there is like what we call these like hybrid policies exist. So you can have a life insurance long-term care policy. And if you do use it for the long-term care, like it's great. But if you don't use it, at least your family gets some kind of benefit when you do pass away. And most of the time, if we are in the speed limit, these policies pays us tax-free benefit to pay for the long-term care. Just imagine that, you know, having a $10,000 to $15,000 a month expense, if we weren't planned, it's a lot of money.
That's a fantastic option. Thank you for sharing that.
And especially if you're under the age of 65, I think that's one of the biggest concerns, because obviously we don't get Medicare until we turn 65 years old. So what happens if you're forced into retirement when you're 62 or you're 60? There's a period of time there where you need to figure coverage out on your own, whether you're taking COBRA for a limited period of time or you're going out into the marketplace. And that's just on the health side. Obviously, as you talked about long-term care, you got to coordinate this stuff together, I think.
Absolutely. And Ozzie, I want to ask you, what about establishing multiple income streams and side hustles, if you will, to help bridge a gap if there is an income gap because you're forced into retirement early?
Yes, and when there is the income gap, like we talked about earlier, you know, we need to find a way to how to close this gap in all different sources. And Prashant, you know, talked about this earlier. We have to find a way that is going to generate us extra income. This could be real estate, and this could be bond portfolio maybe, or like we talked about the fixed index annuities to create an income stream. But at least we need to find this for the guaranteed for the rest of our life. The one thing that some people do not think about it is like, you know, let's say like you guys are making like $10,000 a month when you're working, and when you do retire, oh, I don't need $10,000, maybe need $6,000. But that's not completely true. I mean, you work so hard your whole life that you're going to do sacrifice at your retirement because you don't have enough income. You just need to find a way to create this income, and it has to be the guaranteed for the rest of your life.
One thing we always say is that when you get to retirement, the higher the income, the better the outcome. Okay. Usually higher higher amounts of income lead to a more comfortable lifestyle. Folks, higher the income, the better the outcome, we believe, when you get to retirement. Let's open up those phone lines again, 833-308-5200. That's 833-308-5200. Or you can visit retiremaryland.com. Now, when you call that phone number, have your calendar in front of you. We have a great team of operators standing by. They're going to be able to book you into one of the time slots that's available in our calendar here very shortly. When you come into the office, you'll visit with our team of specialists. We'll help you look at a real retirement plan. It's going to include an income plan, a Social Security optimization report, a risk assessment, and then we do have to talk about taxes. Cynthia, maybe we can do that after the break. We have to talk about the impact of taxation in retirement. So pick up the phone, get off the couch, pick up the phone, give us a call, schedule that complimentary retirement review today.
Prashant, thank you so much. Ozzie, thank you so much. To our viewers at home, that number to call, 833-308-5200. You deserve to have your very own Retire Smart roadmap. No matter where you are on your journey for retirement, this will allow you to have peace of mind that you will indeed reach your destination. Once again, 833-308-5200. We'll be right back momentarily after this very short commercial break.
The work never seems to end until the day it finally does. After nearly a lifetime on the job, you should be rewarded for all the time you spent working. Whether that's crossing off items on your bucket list, learning a new passion, or rekindling the love of an old one. After all, life isn't over when you stop working. It's the start of an all-new chapter. The one where you're the writer and you get to choose how your story will go. A way to achieve that is by having a clear financial plan to sustain your golden years. The biggest fear most retirees have is if they'll have enough money to maintain the lifestyle they've always enjoyed. Having a plan to help protect you against the curveballs life often throws will help to maintain your lifestyle. Call today to get your free written financial plan so you may live every day to the fullest and enjoy the retirement of your dreams.
Welcome back to Retire Smart Maryland. My name is Cynthia DeFazio, joined today by Prashant, Sabapathi, and Ozzie Culhagil of Elite Income Advisors. And we're talking all about what if you are forced into an early retirement? What are some things that you can do today? And in this segment, we're going to talk about taxes in retirement because we have to address the elephant in the room. I think it's super important to talk about taxes. I'm so glad that you brought that up, Prashant, because obviously so many people, they fail to plan for their taxes in retirement. And how can that derail if that be the case?
So let me start here. Let's say that we have $1 million retirement portfolio, and let's say that it's all in pre-tax retirement assets. So I'm talking about 401ks, IRAs, traditional thrift savings plans, 403b. We put all this money away into this retirement account so that we could get the tax deduction up front, hoping that when we got to retirement, our tax bracket would actually be lower so that when we withdrew the money, we'd pay a less amount of taxes, okay?
Right.
Let me ask a question. Do we think that 15 years from now, do we think that income tax rates at the marginal level, do we think that they're going to be higher or lower than what they are today?
I think it's going to be higher.
I agree.
I think
higher.
most people we talk to think that rates are going to go up because of the state of the national debt and Social Security funding and everything else. So going back to that $1 million portfolio that we had, let's say that we always plan to take about $40,000 or 4% off of that portfolio. Great. So now you're taking $40,000, but then what happens? Let's say tax rates go up. When you now take $40,000 off that million, are you netting the same amount of money as you were before? Of course not.
No.
Right? Because rates went up.
Right.
And so the issue is you still needed that $40,000 to live life the way that you wanted to.
It's true.
And so now what are you going to do? You're going to have to take more. Instead of taking 40, maybe you're having to take 45 or 50 because tax rates went up. So what you've done is you've increased the withdrawal rate on your assets. When you increase the withdrawal rate on your retirement assets, does that increase the probability that you might run out of money one day?
Absolutely.
Absolutely. And so in your mind, you think, well, now I have to grow more, and so I have to take more risk.
More risk.
And if I have to take more risk, that could mean that I could lose more money, right? So taxes going up, it's not quite as simple as, hey, I'll always have to pay my taxes, so I'll just deal with it. This is why we talk about bucketing your money. We think that you should have red bucket, we call it the red bucket, which is risk money. That's designed to protect you over the long term against cost of living adjustments by growing your money.
Okay.
And then we have a green bucket of money. We call it green because it's totally safe. And that safe bucket of money is supposed to give you all of the income that you need so that when there are tax increases in the future, you can draw from either bucket that is most favorable at that particular point in time to offset some of the income gap that you have. So everything works together. I cannot stress that enough. Your income impacts your investments and income both affect your taxes. It all affects your health care plan and Medicare plan as well. Everything is so coordinated.
Yes.
My opinion, the strategies of 20 and 30 years ago they just don't work quite as well in today's day and age. And so we got to get with the times, and we got to get a plan that actually works for us.
I love
What do you do to create this tax-free?
So yeah, it's a great question. What do we do to create tax-free income? I think one great strategy is to use like a Roth conversion, right? So Roth conversions, when you take your pre-tax retirement money, you convert it to a Roth, and then any subsequent growth you get on that money is actually totally income tax-free, provided you're over the age of 59 and a half, and provided that you've held that account for at least 5 years.
Wow.
And so tax-free, in my opinion, is always better.
Absolutely.
And so why not pay the taxes today, do a Roth conversion, and then never have to worry about it again, right? Now, I'm not saying that everyone out there should go and do a Roth conversion, okay? So if you're listening to this, I'm not saying you need to go do a Roth conversion right now, but what I am saying is that everybody listening should, at the very least, evaluate whether or not doing a Roth conversion could be the right thing for your plan. What are some other benefits, real quick here, for the Roth IRA?
So the other benefits are, when we do the Roth IRA, then we, like, if we have the regular IRA, when we come to a certain age, at this right now moment is the 73, even though we don't need to take money out from our pre-retirement accounts, the government is forcing us to take money out. So when we do that, you know, all of our taxes and the Medicare and everything goes up. But if we have the Roth IRAs, we can leave that money tax-free to our heirs, and we never, ever have to touch if we don't need to touch.
There's no required minimum.
There's no required minimum distribution, which is, I believe, is the best source of money you can leave it to your heirs, is the tax-free bucket.
That's a gift, a true gift.
Folks, if you're not sure about the tax efficiency of your accounts, if you're not sure what order to withdraw your retirement investments in, if you're not sure how required minimum distributions could impact your tax bracket and your Medicare premiums, pick up the phone and give us a call. Last opportunity for today's show to get in the schedule for that complimentary, no obligation visit with our team. You're coming in to figure out whether or not our team is even the right fit for you. Some of you will find that we're a great fit. Others will find that it was just an educational experience. Whatever that looks like to you, pick up the phone, give us a call, 833-308-5200. Come visit with our team of specialists to get your Retire Smart roadmap in place today.
To our viewers at home, thank you for spending time with us today on Retire Smart Maryland. We look forward to seeing you back 1 week from today. Take care now.